Good day, everyone. Welcome to our webinar for the 5th of February 2020. Quite a lot has happened over the festive season, and there's much that needs to be commented on. First of all, the world economy seems to be in a much better shape than it was 6 or 7 years ago, mostly due to the recovery of the US economy, which has also flowed through to other economies in the world, particularly Europe and also China. But in November 2019, at the end of November 2019, there was still $15 trillion in government bonds worldwide, which was earning a negative real return. In other words, the rate they were getting was lower than the inflation rate of the country in which those bonds were part of the government financing. This indicates that investors worldwide are still in a state of fear. They're still worried that there will be a return of the recession and that there will be some kind of economic meltdown. Obviously, you only invest at a negative real return because you want safety above return, and that's the critical issue. In South Africa, of course, the CPI is at 3.7% and government bonds are yielding over 9%. So the real return is over 5%, which is what makes South Africa attractive to overseas investors. But there is obviously still considerable fear amongst international investors that there will be some kind of economic collapse. The way we interpret that is that we say that this is a good indication that the current bull trend, which is taking place in America and elsewhere, and which you can see on your screen there, in the form of the S&P 500, is still in progress. We believe it still has some distance to go. SA bonds are offering the best real return of all emerging markets. So if the sentiment, international sentiment amongst investors shifts back towards risk on from where it is now risk off, it's quite probable that South Africa will see a flood of cash coming into the country. And if we consider the American economy, US consumers are doing pretty well. In November and December, the average retail sales level was 4.1% higher than in the previous year, in 2018. That's very strong. Considering the size of the American economy, it shows that confidence levels in America are at pre-2008 levels. And of course, 2020 is an election year. So Donald Trump is unlikely to do anything to make the economy worse. In fact, it's one of his best election campaign issues is the economy. He's relying on that. So we can't expect anything from the government to derail this boom. I think that he will be depending on people's 401k retirement plans going up in value this year because the S&P 500 goes up. Online sales in America were 18.8%. We're up 18.8% in 2019 and made up 14% of all retail sales. And that figure means that there was $7 trillion of sales. And that is expected to double in the next 5 years. So the whole world is shifting towards online retail. And that's something we need to bear in mind here in South Africa. If you look at the chart, which is on your screen here, we can learn some things from this. Markets always overreact. And the size of the overreaction depends on whether sentiment is positive or negative. If you're in a strong bull trend, you will find that corrections are smaller and last less time. And sometimes they're even just periods of sideways movement, flat movement. If you're in a bear trend, downward trends are emphasized and are stronger, and vice versa, of course. The S&P 500 peaked here, as you can see, on the day before the public holiday in America, the Martin Luther King Day. So they peaked on the 19th of January 2020. And that peak came after this 4-month upward trend here, strong upward trend. And that upward trend has been going on since October, as you can see here. Now, that means that the market in America is looking for some kind of correction. when you see a strong upward trend like this, you know that sooner or later there's going to be a correction. And the longer that trend goes on upwards, the more likely that correction becomes. And of course, we know that Donald Trump has more or less stopped making unpleasant remarks about the Chinese and threatening them with trade wars and so on, and he's busy resolving that situation. So what else is there that the markets can correct over? Well, the obvious solution was the coronavirus. When the coronavirus hit China, it obviously impacted on markets. In fact, last Monday, the Shanghai Stock Exchange fell by 8.7%, and the Shenzhen Stock Exchange was down 9%. The S&P 500, as you can see from the chart here, has so far fallen about 3%. Of course, the confirmed cases of corona and the death toll are climbing. China, of course, is a major importer of commodities, so that impacts on us here directly in South Africa because we export stuff to them. And they also are a major source of tourists for South Africa, so it will impact our tourism business. And of course, the coronavirus is causing a slight shift towards risk on, so that will cause money to be removed from emerging markets. If this correction is like other corrections in the past, we can expect it to rise to at least 10%. In other words, it will fall 10% from this high point here and maybe even further. Well, a 10% fall from that level will take us down to about 3,000, to the S&P level of about 3,000, which is down here somewhere. Quite a substantial fall. But in our opinion, and the opinion that we wish to convey here, is that this is just a correction. This is not the beginning of a bear trend. And therefore, as a private investor, you must view it as a buying opportunity. We do not believe that this correction will be very sustained. And to put some perspective on it, so far the coronavirus has killed just less than 400 people and infected maybe 17,500 from the latest statistics. In America, every year, the ordinary flu and cold kills 30,000 people a year. So that will give you some perspective on this coronavirus. And remember, the flu virus is a member of the corona group, and that kills 30,000 people a year in America. And nobody worries about it because it's quite normal. Of course, the people who die are either very young or very old or have a compromised immune system for some reason. So that's why we believe that this is a correction and therefore a buying opportunity. In that regard, you should probably take a look at Process, which of course has exposure to China through Tencent, through its 31% holding of Tencent, and is being impacted by the development of the coronavirus. Its shares are off. So you need to take a look at that and decide for yourself whether it's come off a long way or enough. Remember that Process, though, before the coronavirus, was already trading at a 30% discount to the assets, the market value of the assets which it held, including Tencent, of course. All right, let's consider the South African economy. Recent figures out from the Treasury are a bit scary. They show that in December of 2019, expenditure for the government was up 14% over the previous December of 2018. At the same time, tax collections have actually fallen by 0.7%, mainly due to the recession and, of course, the re-implementation of load shedding. What is most concerning about these figures is that they do not seem to indicate that there has been any real progress made in reducing the government's wage bill. The wage bill is not coming down. And expenditure is going up, of course, because they are subsidizing various state-owned enterprises. The result of this? Well, after the February budget, at the end of February this month, Moody's downgrade looks almost certain. GDP growth last year was about 0.4%. The Treasury believes that this year, 2020, will see 1.2% growth. The International Monetary Fund, however, disagrees and says growth will be about 0.8% in 2020. We think that actually growth will be quite positive this year. We're looking for about 1% and maybe more. Of course, there's enormous pressure on Cyril Ramaphosa as the president, and you have to remember that there's an ANC National General Council meeting later on this year, so he's under pressure. The pressure has been to remove Pravin Gordhan from his current post and to put Eskom under the control of Mantashe in his Department of Minerals and Energy. Such a move, of course, or those moves would clearly have a bad impact on the rand. The Monetary Policy Committee brought interest rates down by 0.25%, which in November, which was quite unexpected. The repo rate is now 6.25%. This, of course, makes South African bonds less attractive to foreigners, but we have a very low inflation rate. Inflation in South Africa at the moment is at around 4% in December, and it's estimated to be about 4.7% in 2020. There is, of course, room to bring rates down further. They could, in fact, come down by as much as 1% from where they are. But the Reserve Bank in this country is very conservative. The good news, of course, new vehicle sales were up sharply in 2019. They were up 10%. And local sales of new vehicles were up 4.2% in December year on year. So that may indicate some revival of consumers in the country. If we look at the state-owned enterprises, Eskom, under its new CEO, Andre de Ruyter, is saying that we can look forward to 18 months of intermittent load shedding while they fix the problem, go back and do planned maintenance and so forth. This rather negative picture is mitigated somewhat by the independent power producers who say that they can produce up to 3 gigawatts of additional power, and not only that, they can produce it for 40 cents a kilowatt hour, which compares with Eskom's current rate of about 90 cents a kilowatt hour. The mining industry also has considerable resources applied to generating their own electricity. They believe that they can generate about 609 megawatts. All they are waiting for is licenses from the Department of Minerals and Energy, which of course goes back to our friend Gwede Mantashe. At the ANC Lekotla recently, their 2-day Lekotla, it was decided that municipalities should be allowed to buy power from independent power producers, and obviously that's very good news for Cape Town, who've been lobbying for that particular situation for a long time. That obviously means that Eskom has to become more competitive if it is to survive. They also plan to expand the IPP program, and that's also good news, but obviously it's not going to have an immediate effect. They will also allow businesses to build their own power generation. This is a very, very important point, and I think a lot of companies are waiting for this type of thing, where they can run their own power situation. They're not dependent on Eskom. They're not vulnerable to Eskom's power prices or to their unreliability. Of course, SAA has become a bit of a basket case. It's quite clear by now that the strike that they had there caused them to lose vital business. Finances deteriorated. They're now in business rescue. They got a 3.5 billion rand loan from the IDC, plus another 2 billion from the banks, which is government guaranteed. They've had to cancel a whole lot of flights to save costs. But liquidation is not an option, because if they are liquidated, the government will have to repay 40 billion rand of SAA debt, which is guaranteed. So the ANC says that they intend to keep SAA, but substantially restructured. Nobody quite knows what that restructuring is going to look like, and they haven't been telling us. Let us turn our attention now to the rand. Of course, all developments at state-owned enterprises and in the economy are reflected directly in the rand. The government's apparent inability to reduce the government wage bill and the threat of junk status, which looks almost inevitable now, are directly reflected in the strength of the rand against hard currencies like the US dollar. So you can see here the chart against the US dollar, and you can see that the rand has been weakening really since February of 2018. But it has been in a sort of sideways pattern here for a while, bounded on the upside at a level of about 15.30 and on the downside at a level of about 13.25. So there's that sideways pattern. In the last week or so, it has weakened back towards 15 rand. And that is obviously because of the government's inability to control the wage bill, plus the lower tax collections, which obviously indicate that a downgrade is almost inevitable. But we believe that a downgrade has been very substantially discounted, not only into the rand, but also into the government's long bond. And so we don't think that the rand will break through this resistance here at about 15.30. So we are looking for it to stay inside that range. If it breaks below that level, then we were mistaken. But that's our opinion at the moment. I want to draw attention now to a couple of general factors. The A2X is the Johannesburg Stock Exchange's most serious competitor. It has now reached a market capitalization of 2 trillion rand, which makes it very substantial. Big shares like Standard Bank and Naspers have their secondary listing on the A2X, and because the A2X offers cheaper brokerage, they're obviously taking business away from the JSE. The JSE has been forced to reduce dealing costs, and that is good for private investors. And the other thing is that the A2X is planning to take primary listings from 2020. At this stage, they only have secondary listings of companies that are already listed on the JSE. But later on this year, they're planning to take in primary listings, so that will change things as well. The other general point that I want to draw attention to is the shift to electric cars. This is gaining momentum worldwide, and it's going to be a very big factor in the world economy over the next decade. Electric cars are now about 20% cheaper than their petrol or diesel equivalents. So the fact that they're 20% cheaper to run, and that includes everything, the capital cost, the fuel cost, maintenance, everything. So over the life of the vehicle, it's about 20% cheaper. That means that slowly electric vehicles are going to take over from internal combustion engines. South Africa must obviously adapt. We have a large vehicle manufacturing industry, and the government here must remove tariffs on imported electric vehicles. They must subsidize the purchase of electric vehicles, and they should roll out charging points at petrol stations so that electric vehicles can recharge easily. It's estimated that overseas, in the rest of the world, electric vehicles will make up roughly 12% of the market by 2026, and roughly 50% by 2040. So this trend is coming, and it's coming quickly, and we need to adapt. Let us turn our attention now to commodities. Obviously, growth in South Africa, economic growth in this country, has traditionally been export-led. This is because we are primarily an exporter of raw materials. When the prices of commodities rise, that filters through to the rest of the economy, and the entire economy starts to perform better. Of course, commodity prices turned up in January 2016 and have been rising ever since. If we look at the mining industry, the mining index on the JSE, let's put this chart on the screen so that you can get an idea of what I'm talking about. I'm going to go to 5 years. You can see there's the low point in January 2016, and there's an accelerated upward trend here, which I've kind of tried to mark a little bit here for you. And that accelerated upward trend is really of great interest to this country, because a lot of our wealth comes from minerals, raw materials, which we export. So a lot of companies are making money out of this, and as those companies make more money, they employ more people, and the wealth filters through to the rest of the economy. And I think that this prosperity in the mining industry is actually masking the really depressed state of the rest of the economy. In other words, the growth in mining, despite the fact that the mining charter is very investor unfriendly, but the rising prices has helped South Africa and the economy to stay afloat during these difficult times. I think if it were not for mining, we would be in a deep recession by now. And we think that this trend will continue. We think that the rise in the prices of commodities is going to continue in 2020 and beyond, because it's being driven by world growth, by the growth of the world economy, and particularly America. The third mining charter, of course, is out. It is a great improvement on what Mosebenzi Zwane had, but it is still lacking. and it is being contested in court by the Minerals Council of South Africa. Gwede Mantashe has published rules which are retrogressive in our opinion. The mines are now burdened with all sorts of new duties and costs towards the communities in which they operate. This, of course, is chasing away mining investment. What the Minerals and Energy Department doesn't seem to realize is that we are competing for these investment dollars with Brazil, Argentina, Australia, and many others. So we need to be competitive. The palladium and rhodium prices have been rising rapidly. So if you just look at palladium, the price has gone up to about $2,300. I'll just put a bit more data on the screen here. You can see the rise in the palladium price. It's been nothing short of dramatic. And Johnson and Matthey are expecting the price to reach about $2,500, which is very good for Sibanye, which of course, as you know, spent $2.2 billion to buy a palladium mine in America at Stillwater. Rhodium is also going up very rapidly. It's a much smaller market, but the price is $8,000 an ounce now. And it's interesting that South Africa produces about 80% of the world's rhodium. We also said in June of this year, we published an article in which we called the New Gold Bull, and we said that the gold price had broken up through a key resistance level. So I'd like to just show you that, draw your attention to it again. Here you can see the gold price, and there's the upside breakout. Maybe just put 10 years on here so that you can see this more clearly. Gold was operating within a wedge, and it's broken quite clearly out of that wedge. We published our article over here and drew your attention to the upside breakout. Since then, the dollar price of gold has gone up about 17%, and so far the index has gone up about 40% in just over 6 months. So this would have been a great investment if you'd taken our advice on that one. While we're on commodities, I just want to talk about Glencore. They've had to close their ferrochrome smelter in Rustenburg, and in the process 665 jobs have been lost. This is mainly due to a 6-fold rise in the price of electricity from Eskom since 2006. And in fact, there are now about 40 smelters in South Africa which are closed down, which is leading to a really crazy situation. We're exporting our chrome, our nickel, our iron, and other metals overseas, and then importing cheap steel and putting our steel industry in danger, and we're losing jobs on both sides of that equation. And most of it is because of the high price of electricity. Another factor in the commodities market which is of interest to South Africans is that coal-fired power stations are closing down all over the world. This is making our exports of coal more difficult because we obviously have to compete more aggressively with other countries in the world who also produce coal, like Australia. 57% of our coal goes to India, but the price is under pressure, and South Africa is going to have to up its game in coal production if it wants to stay in that industry. The global energy transition is gaining momentum, and it will have an impact on many industries throughout South Africa. All right, let's turn our attention now to companies. There's a new listing which is coming onto the market. Investec is busy unbundling its asset management business. The new company will be called 91 for some reason, and Investec shareholders will get 1 share in 91 for every 2 that they hold in Investec, which gives it a market value of about 28 billion rand when it lists. It actually controls about 2.25 trillion rands worth of assets. This is not really an unbundling. It will not release shareholder value, but it is of interest because you'll have a new blue chip asset manager on the JSE in due course. Turning our attention to construction, the Afrimat index has come out and it shows that construction might have turned the corner. The end September quarter looks very good. I'm obviously talking about end September 2019. It shows a 5.1% increase in the index. Sanral is apparently issuing more tenders. Building plans are up 9.5%. Retail hardware sales are up 8.4%. So maybe we're turning the corner in construction, and maybe there are some bargains there to be had. And I'm thinking particularly of countries like Avenge and Murray and Roberts and so forth. Omnia, this is a diversified chemical company. In the 6 months to the 30th of September 2019, their headline earnings per share were 49 cents, which compares with a loss per share of 122 cents in the previous period. They did a rights issue, and they raised 2 billion rand, which was oversubscribed, which is always a good point. When you're looking at rights issues, you want to always see if it's oversubscribed or undersubscribed, because that shows that investors are very keen to buy up these shares in Omnia. And they've used the proceeds to cut their debt by about 1.4 billion rand. The net asset value of the company, let's just go to the share so that you can have a look. The net asset value of the company is around 105 rand per share. And at the moment, the share is trading for about 33 rand. If we take a 5-year look at this share, or let's go to 2 years, you can see here that it's been underneath this moving average for a long time, and now in November it broke up through that moving average, and it's been moving sideways, but we believe that it is very cheap at the moment, trading, as I said, for 33 rand when it has a net asset value of 105 rand. It seems to have overcome its major problems and looks set for a new upward trend. Clearly it's dependent on the South African economy recovering, but we don't think it'll get much cheaper than it is now. Afrimat, which we mentioned just now in connection with its index, and we have extolled it on many occasions here in this forum, and said that it's a good buy, has produced a set of results which are very good. The share price, however, is still trading at around 32 rand, which means it's on a price-earnings ratio of less than 10. It's got a very strong balance sheet. It's completely reinvented itself as a miner of base minerals and metals. And in the 6 months to the 31st of August 2019, it announced headline earnings per share were up 94%. Also brought its debt-to-equity ratio down from 36% to just 9%. So that's a company which is worth looking at. SPAR. SPAR is an international supermarket chain. They obviously have a great deal of stores here in South Africa. 2,349 stores. They also own Build It and Tops Liquor. They also have operations in Southern Ireland, where they've got 1,381 stores, and in Switzerland, where they have 315 stores, and they've just bought 66 stores in Poland, Poland being the fastest growing economy in Europe. In their results to the 30th of September 2019, their turnover was up 8.4%, and headline earnings per share were up nearly 10%. That is a remarkable achievement for a retailer in South Africa. And obviously this company benefits substantially from its overseas investments and its overseas stores. And then the Fraschini Group produced a great set of results. We've always liked Fraschini. It's one of the better retailers. In the 9 months to the 28th of December 2019, their Australian turnover is particularly notable. It was up 11.4%. This is nothing short of amazing when you compare it to what Woolworths has been going through with Country Road and so forth. In its SA operation, the South African operation, its turnover was up by 5.9%, which is also very respectable. It trades on a price-earnings ratio of about 12, which seems to us very reasonable. If you look at the long-term trend, the share is clearly in an upward trend, all right? And we suggest that it's a good blue-chip share which is trading at very low levels right now and could be worth your consideration. Finally, we want to talk about Rebosis. Rebosis is a small property share, mostly known because it was the first black-owned and controlled property share on the JSE. I just want to look at a bit more detail. Here you can see how the share has got into trouble. They overextended themselves by buying a company called New Frontier in the UK for about 1.2 billion rand, which they were then forced to sell a little while ago for 700 million rand, and they blamed this on Brexit. And the share price has been falling. We put on a moving average onto it, and we've been waiting, and as you can see here now, it's making some kind of what we call a saucer bottom. There's been an upside breakout. The share is now trading above the moving average, which is a buying signal. And of course, it's very cheap. The share is trading at about, on a market capitalization, as you can see from this chart, of under 300 million rand. But Quadrant Properties, which recently did a valuation of its properties, says that its properties are worth 12.8 billion. So you're buying 12.8 billion rands worth of assets for 300 million rand. That's got to be a good deal, and we believe that the share could become a takeover prospect. We certainly don't see it falling much further from its current levels. Folks, that's about all I've got for you today. So I hope that you have good investing over the next month, and I'll talk to you again on the first Wednesday of March. Thank you.